In this topic and the next topic, we'll take a close look at another category of alternative investment opportunities, private equity. Private equity means equity of private companies. However, private equity firms do not only invest in equity of private companies. There are four major categories of private equity strategies. They are venture capital, leverage buyouts, mezzanine financing, and distressed debt. Private equity firms or funds can be categorized according to these four strategies. Generally speaking, a common theme of the strategies of private equity firm is they invest in companies that are generally unavailable for investing by most investors, or in a way that is generally unavailable to most investors. And they also invest in companies that have limited access to external finance. Two common features of private equity investments are illiquidity and a long investment horizon. Investors who invest in private equity funds need to be patient, as the investment horizon tends to be very long. This topic focuses on venture capital and leverage buyouts. We will talk about mezzanine financing and distressed debt in next topic. What is a venture capital? Venture capital generally refer to finance provided to young startup companies. Firms that provide finance to young startup companies are generally called venture capital firms. Young startup companies have very limited access to external finance. They are not listed, so have no access to public equity finance from the stock market. It is also very hard for them to borrow money because they have unproved business models and products, no established credit history, and no established track record of earnings. A typical young startup companies tend to lose money over the first few years. Startup companies also have very limited tangible assets to back their loan. However, some startup companies have huge growth potentials. Venture capital firms provide finance to these really financially constrained startup companies, but with huge growth potentials. Venture capital firms are not just the capital providers. They are also highly involved in the growth of the startup companies in their portfolio. However, there is still a high chance that a startup company eventually fails. So venture capital investments are actually very risky. But of course, if a startup company succeeds at the end, the return can be very high. A venture capital firm can take the organization form of limited partnership, limited liability company, corporate venture capital fund, and venture capital fund of funds. Limited partnership is the most widely used organization form for a venture capital. Venture capital firms may have their specialized industries, specialized regions, and/or specialized stage of financing. There tend to be five stages of venture capital financing for a typical startup company. And different venture capital firms may step in at different stages. The five stages are angel investing, seed capital, early stage venture capital, late stage venture capital, and mezzanine financing stage. We would expect higher return for investments in earlier stage. As we already know, venture capital investments involve long investment horizon. It takes a few years for a venture capital fund to raise money, identify good startup companies, and then make investments. It takes another few years for these startup companies to grow and make a profit, and for the venture capital fund to exit their investments. A typical venture capital fund tends to generate negative returns over the first few years, as management fees are charged every year even before any profit has been made. A typical venture capital fund generates returns at the later stage of its investments. We call such a pattern a J-curve. Venture capital investments have large exposure to extreme events. If a startup company fails, the loss will be huge. If a startup company succeeds, the gain will also be huge. It has been observed from the historical data that investments in venture capital are very risky and have large exposure to extreme events. However, returns are positively skewed. It has also been observed that correlation between venture capital investments and the traditional financial assets of stocks and bonds is low, so venture capital may improve diversification of a portfolio containing traditional financial assets. Then the next question is, what is leverage buyout? Unlike venture capital firms who only invest in startup companies, leverage buyout firms invest in established companies. Leverage buyout firms tend to use high leverage to take a public company private or acquire an established private company. Leverage buyout firms target at companies that they believe meet the following two criteria. The first criteria is the company is temporarily undervalued due to certain problems that can be resolved with the efforts from the leverage buyout firm and or the current management. The second criteria is something can be done to increase the value of the company with the efforts from the leverage buyout firm and or the current management. A leverage buyout normally involves taking really high leverage by using the target company as the collateral. After the buyout, the debt of the buyout becomes the debt of the target company. Therefore, a target company with potentially higher debt capacity, which can facilitate the borrowing for a buyout, is more appealing than an otherwise identical company with lower debt capacity. For example, the current leverage, the amount of tangible assets, and the volatility of earnings are some examples of factors that affect a company's borrowing capacity. It has been observed from the historical performance that leverage buyouts are less risky than venture capital, and the returns also tend to be lower. This finding makes sense because leverage buyouts invest in established companies with less uncertainty involved, and many leverage buyouts involve taking a public company private. It is easier for a once public company to go public again in the future, so the exit is easier for those leverage buyouts. It has also been observed that the correlation between leverage buyouts and bonds is low, so leverage buyout investments may improve diversification of a portfolio containing bonds.